Let me tell you about the worst introduction to investing that you can ever have. This is actually how I got introduced to the stock market. Ready? I was in my late 20s, still working as a researcher at MIT, and I had to update which retirement plan a tiny part of my paycheck was going into. There were literally hundreds of funds to choose from, and they all had these complex pages filled with graphs and ratings and data that tell you everything about the fund except what's actually in it. So the time horizon was like 40 years. I had no idea whether I was holding stocks, bonds, or funds, and some nameless, faceless fund manager was actually doing all of the investing for me. Even though I successfully picked my own retirement fund, I learned absolutely nothing about the stock market. I think a lot of people used to get introduced to investing this way, so I decided to try and figure it out for myself. After all, I'm a pretty smart guy. After doing about 45 minutes of research, I was an expert. I ended up buying a ton of AMD stock for one reason. I thought their products were about just as good as Nvidia's, but AMD's stock was about 4 times cheaper. Invest in what you know, right? This was back when making trades still cost about $5 a pop, so the stock price really mattered to me since I could spread that fee out over more shares. I didn't really know anything about market caps or balance sheets. I just saw a company that I liked with a cheap stock, so I went in on it pretty hard. After all, it couldn't really get much cheaper, could it? Well, it turns out Nvidia was absolutely killing it. I think AMD ended the year down like 25%, while Nvidia was up like 75%. So I did what any smart person would do. I started putting my money in Nvidia instead. After all, that stock was going up. That's when I started really paying attention to the stock market. And after about 6 months of putting my money in Nvidia and not AMD, Nvidia crashed and AMD took off. So I did what any smart person would do. I yelled at my computer screen like a crazy person because I was convinced that the stock market was rigged. Fast forward to March of 2020 when the stock market crashed again. Cool. I logged into my brokerage account, and what do you think I saw? I was way up on both AMD and Nvidia because I was holding them for a few years at that point. That's when I did what every smart investor eventually actually does. I admitted to myself that I wasn't a smart investor at all and that I didn't understand the stock market. So I sat down and I started to learn for real. I'm telling you that story because right now is another great time to be learning about stocks. That's why I'm always sharing what indicators I'm watching and what stocks I'm learning about. And trust me, I am still learning. Anyone who tells you they know everything is lying to you, and probably to themselves as well. The other thing you really need to hear is that every single investor makes mistakes, especially when there are big changes in the market like what's happening right now. If you weren't invested before 2017, this is the first time you're seeing a stock market with rising interest rates. If your portfolio is in the red right now, you're not alone. If this is your first time catching one of my portfolio episodes, I put $100,000 into the market to celebrate this channel hitting 100,000 subscribers back in November, and I show everyone what's in it every month. Last November also happened to be when the Federal Reserve announced that it would double the pace that it's going to raise interest rates, something that they haven't done since 2017. I really focus on future tech and growth stocks, so I basically threw $100,000 into the market at the worst possible time. My only real advantage is that this isn't the first time I'm going through it. So, here are 3 solid habits that I've picked up by investing in growth stocks as they've been crashing. The first one is being able to explain exactly why you're buying or selling something. You will suck at investing forever if you can't make logical, numbers-based decisions for yourself. If you're buying and holding a stock that just had a massive rally, you need to ask yourself why. Specifically, what price do you expect to sell it, and how many shares are you expecting to sell? If you're selling a stock as it's crashing instead of buying it, you need to ask yourself why you wanted it when it was more expensive, but not while it's getting cheaper. If someone else recommended that stock to you, what was their reason? Is that reason still true? If so, why are you selling it? If you have a good logic-based answer, that's great. But if you don't, that little pause may have just stopped you from making a bad decision. And if you have no cash to do either of those things, you need to ask yourself why you thought it made any sense to spend all of your money at whatever prices that you just spent it at. If you can't answer those questions with facts and numbers about your companies and stocks, chances are you're investing with emotions instead of reason. By the way, I'm not criticizing you. We've all been there. It's something that I'm still working on myself, but that's something you will have to work on if you want to become a better investor yourself. So here's exactly how I'm working on it. I stopped making any decisions all at once. I dollar cost average in and out of individual stocks now. Let's take a look at my biggest position, which is Sea Limited. Sea Limited is by far my highest conviction position and a stock that I keep up with regularly. The price dropped 30% last year. Wow, what a great buying opportunity, right? Well, turns out not really. It actually dropped another 30% after that and another 30% after that. In total, Sea Limited dropped 75% from its all-time highs, but because I dollar cost averaged into it, I'm only down about 30%. Let's take a look at another one. I'm down 13% on Teladoc. Is that a lot? Is that not a lot? It turns out that Teladoc is also 75% down from all-time highs. 13% doesn't sound so bad now, does it? In fact, as long as I have money on the side, I don't mind my positions being down. So I dollar cost average in, which forces me to keep cash on the side and buys me time to adjust as the market changes. This has helped me limit my downside tremendously, and if you find yourself selling a stock that's up only to see it keep going way higher, averaging out is also a great way to stop limiting your upside. Speaking of upside, Public.com is now offering a free slice of stock worth up to $1,000 when you fund your account. Talk about a massive upside. Check out that limited time offer at public.com/ticker-symbol-U or use the link in the description below. That actually brings me to the second good habit. Whenever I look at a stock, I try to think about it in terms of time, not just price. Again, let me show you exactly what I mean. Teladoc stock is at an $11 billion market cap today. The last time this digital healthcare company was at the same market cap was in April of 2020, basically at the start of the pandemic shutdowns. I'm calling out Teladoc's market cap specifically here and not its stock price because it made a major acquisition between these two dates, so it has a lot more shares outstanding today. So when I buy Teladoc at this market cap, I'm basically going back in time and asking if I want to buy it on April 6th of 2020 with all the information I have on it now. It's at the exact same valuation as it was then, but it's not the same exact company. For example, Teladoc's quarterly revenue in quarter 2 of 2020 was $241 million. Last quarter, it was $554 million. So since the last time Teladoc was at this market cap, they've more than doubled their quarterly revenue. If you're going by their trailing 12-month revenue, they've actually almost tripled it. Even after the pandemic, their trailing 12-month revenue grew by 45% year over year. Think about that. In 2020, a global health crisis shut the world down and a ton of healthcare went digital. There's no way a digital healthcare company like Teladoc can keep growing at that kind of pace forever. But they're still growing at about half that pace 7 quarters later. That's insane growth. They've also expanded their gross profit margins by another 4% to 67.5 points. Investors used to be pretty happy paying 20 times price to sales for the stock, and now that stock is just going at a price to sales ratio of about 5. If you dig into what happened between now and then to warrant such a huge shift in sentiment, you'll learn that Teladoc acquired a chronic health management company called Livongo for around $18 billion. That's where a lot of these expenses and losses are coming from. So the market is punishing unprofitable companies right now, but the only reason that Teladoc is unprofitable is because it acquired a company so that it can compete in multiple markets by covering chronic and acute health conditions. If you take out the costs of Teladoc's Livongo acquisition, Teladoc is a profitable company today with a price to earnings ratio of about 15. That wasn't true the last time this stock was at the same market cap in April of 2020. If you want to learn more about how I'm doing that math and why Teladoc is such a big position of mine, check out my deep dive on it. The math is basically still the same, except now Teladoc's adjusted earnings per share would be almost $1. So again, build that habit of looking at a stock in terms of time, not just price. If a company is much stronger than it was before and trading at much lower multiples than last time, chances are it's a much better investment today. The third good habit is a combination of the other two, and it's really just a mental exercise to not get rattled in the first place. Stop looking at the colors inside your portfolio and start looking at the actual numbers in terms of time. I'm still down over 30% on my Sea Limited position, but Sea Limited can easily move up 5 or 6% in a single trading day. So that 30% sounds like a lot at first, but the stock is volatile enough to close that gap after one earnings call. Don't believe me? Look at what happened to Stone. What people don't realize about this Brazilian fintech stock is that it's insanely volatile. It moved up 42% in a single day after its most recent earnings call. So am I worried about being down only 11% on this position now? Absolutely not. It can close that gap in a single trading day. In a previous portfolio episode, I showed the same thing happen with Upstart after it jumped around 30% after an earnings call. I didn't sell either of them now because I know in numbers what valuation I think they can reach, and I'm still accumulating shares as a result. These are not indexes. I'm not holding the S&P 500 where a 2% move in a day is huge news. Being down 30% on the S&P 500 would be a pretty big deal. Being down 30% on a stock that regularly makes moves of 5 to 10% is not that big of a deal. So the third habit is to look at the actual price movements of your stocks over time and use that to see how much you are actually down by in terms of trading days. You'd be surprised how many times you're down by only a few good days. Hopefully, this episode gave you 3 good mental habits for investing as the stock market goes through serious changes. Comment below with other investing habits that you've been building over the last few months. I read all my comments and I'm excited to hear your thoughts. And if you're looking for quicker insights every day, I've been posting new content to public.com, Twitter, Instagram, and TikTok. Yes, even TikTok. So go follow ticker symbol U on whichever channels you already enjoy surfing. Want to know why the market has been so volatile lately and what you can expect over the next few months? Check out this video right here. I think there are a lot of solid opportunities ahead, and I want to make sure that you know when and why. Either way, stay long, stay strong, and thanks for watching. Until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.